Hello and welcome to our latest market update video. Now today is Friday the 29th of July 2022 and this video is brought to you by the Live Trade Room. So the topic of this particular short video is really about stagflation. What does this mean for the markets? So let's get straight in and we'll answer this succinctly as we possibly can, because it is quite it's what we're hearing an awful lot more about, and if we can explain at this kind of early phase in this stagflation process, explain what it is, explain how these markets are likely to react to this type of environment, it might give us some sort of medium to longer term outlooks on these markets. So as always, if we could start with our risk warning, just take a brief moment to familiarize yourself with our risk warning currently up on screen, and let's get straight into it. So what we'll do is we'll start by just explaining very briefly what stagflation is. So a definition of stagflation, it has the main parameters of persistent high inflation combined with high unemployment and lower demand in a country's economy. So we'll just take the inflation side of things first. So as many of you know, if we just have a look at our chart here, this is the S&P 500, CPI came in more recently at 9.1% year on year on the top left hand corner of the screen, and that has progressively moved up over the last 7 or 8 months, from initially 6.8 up to 7, 7.5, 7.9, 8.5, and then we had a little drop, and this is when we saw that print of 8.5, people were projecting the top of this inflation story, and then we saw a little dip, and maybe this inflation, maybe the Fed are beginning to get to grips with it and the markets are responding accordingly. Of course, that's not the case. We've then had 8.6 and now 9.1. So really, really high inflation across the US economy. And this is combined with high unemployment. Now, this is the part of stagflation which hasn't really filtered through yet. What we are beginning to see in certain parts is lower demand. But regarding the unemployment situation, we currently have an unemployment in the US of 3.6% unemployment, which is pretty close to full employment. So that's not such an issue with regards to this stagflation environment as such. But the Fed have tried to try and ultimately deal with this inflation story. On Wednesday, just 2 days ago, on the 27th, we saw the federal funds rate increase from 1.75 to 2.5. There was a lot of debate whether it would be 75% or 75 basis point rate hike, or would we see a 1% move. We saw a 75 basis point rate hike to try and get in front of this inflation story. And it's a way in which the Fed can actually impact demand. It cannot have any material impact on the supply side constraints. So the fact that China is in lockdown and we have containers not being able to leave some of the Chinese ports and take goods and service and transport goods around the world, the Fed can have no impact on that. They can't have any impact on war in Ukraine. And Russia sort of having some sort of control over energy prices and higher energy prices as well. With that, we have the US tapping into 1 million barrels per day from the strategic oil reserves to actually try and have a positive impact on the price of oil. And it's had a certain impact, you would argue. We're still in kind of the mid $95 range for a barrel of oil. So still quite elevated. So we've got, in response to this higher inflation, we've got the Fed looking to act by increasing rates. That obviously can impact a whole variety of different aspects. What they're hoping it will have an impact is kind of very slowly reducing demand. So we hear an awful lot about this soft landing. The Fed is really concerned with the higher inflation. They're trying to make sure we don't get into this stagflation environment for prolonged periods of time. You could argue the Japanese economy have been in this stagflation type environment for 30, 40 years now. And it's not a good place to be. One of the main outstanding elements to this stagflation figure is the unemployment number. currently at 3.6, so really positive as far as that concerned. There is a lot of analysis suggesting, obviously, post COVID, we saw there was enough liquidity out there to encourage corporates to actually take on more staff, and as a result of the Fed tightening, initially they were printing 120 billion per month at a time when it was not really necessary. That's the big concern, the big problem we have with the Fed. In fact, why were they so slow to act? They could have acted a lot earlier. They were printing 120 billion up till the end of last year. They finished that printing process, I think it was at the end of February. So there was an awful lot of money been injected, and companies had access to a lot of liquidity. So they were happy to take on more and more staff to try and facilitate the demand post-COVID. So what does this all mean for these markets? Well, if we look at a market like the S&P 500, and you can apply this across any of the US indices, we were able to see a low around June. So the first half of the year was extraordinarily negative. We literally peaked at the beginning of January. 6 months later, we were down at a low, 36, let's say 3,600, and we peaked at 4,800. So this is a really kind of sizable devaluation, as you can see in, and if we have this retracement figure, we've got like a 30, perhaps to 40% retracement off the highs from the 2020 lows. So that's where we kind of are in terms of a retracement figure. Now, all eyes are likely to be on the employment numbers. The amount of wage, the amount that people's wages are increasing, is it in line with inflation? Will people have more disposable income to be able to buy goods and services and to invest in markets? So that's a real significant question that needs to be answered. And we saw during the week, big corporates like Shopify, get rid of 10% of their workforce first. Sorry, excuse me. They're looking to get rid of 10% of their workforce, literally by the end of the working day. And that sort of knee-jerk reaction, they know there's a lack of liquidity out there. Their business model perhaps can't sustain the levels of demand, which is slowly diminishing. So that fits in pretty much with our broad understanding of stagflation. So it's really going to shift to the employment situation. Will that start to get worse? We're currently at 3.6, which is pretty close to full employment. There's a participation issue really in the markets where a lot of people that were laid off during COVID didn't really want to go back to their current jobs. So there's a participation aspect to these markets, but there's more than enough jobs available for everyone that is looking to find work, and they're not able to sort of improve on our unemployment number. So all eyes will be on whether the fact that we've got higher inflation, the fact that we've got a Fed that's increasing interest rates, will that fundamentally impact demand? And will that take us into this recessionary environment? When we look at recession, you may be familiar with the bond markets. We currently have the 10-year Treasury note, which has kind of fallen off its peak pretty much. We were at 3.5. We're now at 2.69. So this is taking a bit of pressure off the Fed. But we do have an inverted yield curve in the US. So that's when the front end, so something like the 2-year Treasury note, would actually generate a higher yield of 2.91% versus a 10-year, which would 2.6. So we need to bear that in mind. And what that always suggests every time we enter this inverted yield curve environment, it suggests that we are likely to experience a recession. And therein lies some of the difficulties that we can experience as traders. So a recession is not really that good news for corporates. So we want to we're looking at these markets currently as if we've had the initial reaction and response to the Fed increasing rates and what that means for increasing costs and elements of that nature. So we've seen the first part. We've seen the corrective phase on reduction of liquidity, making sure that there's the Fed tapered their bond buying program to such an extent there's a lack of liquidity, and those conditions are slowly feeding their way through the system. So that's what we've seen this first correction for. What we probably haven't accounted for yet is the recession that's likely to come. Now you might be aware, we're still getting some really good positive earnings reports, and largely, in our opinion, the reason for that is the double-edged sword of inflation. Higher prices generates higher income, and the earning situation is maintained. Although the level of demand doesn't necessarily have to increase, but if you have the same amount of people buying a product at a higher price, it generates more revenue. So with all of this in mind, we are still relatively bearish markets like the US indices. We still think there's more upside in the dollar. As people lose their jobs, as their wages get crushed by inflation, it's likely to impact sentiment moving into the next 2 or 3 quarters. We're likely to see that feed through a lot of the economic data, which is more the downside that inflation can have on an economy. This higher inflation, lower growth type environment. And what the Fed are ultimately concerned about is we get demand destruction. So that's when people, you and I, we stop spending at the rate that we're probably currently spending, and we're a bit more conservative. We might go out once a week rather than twice a week, for example. We might have, we might fill up half our tank rather than the full amount. Things of that nature, very, very small. Even in our supermarket, we might refrain from purchasing certain items. We might choose a better value quality product. All of these things, it starts to fundamentally impact demand once people are restricted. And on another little side note, credit card usage is now beginning to go back up again. So that implies a lot of the stimulus packages from the US, people have kind of burnt through that. They've kind of burnt through their savings. Now they're going back towards credit. That's a difficult position to be in. You don't want to really try to, as rates increase, you don't want to be borrowing money, paying back huge interest rates on borrowed money. So stagflation, not good for the economy. We're likely to see a recession. We're already in a technical recession, but that is very much technical. We certainly are of the opinion that although we're getting a little bit of a bounce now, we are still medium-term bearish these US indices markets, and we're actually quite bullish the dollar still. And it's until these dynamics begin to shift, until we get inflation starting to peak and start to come down, we'll be monitoring the unemployment situation very, very carefully. Things like the bond markets, if we get this bond yield inversion, if that maintains itself, it does imply that we're likely to see some fairly poor economic data coming down the line. We've got to be prepared for that. And the Fed have already suggested about increasing rates at a lower pace in September. So there's probably a slight easing. And what that does, if we hit a recession and it starts to get, we start seeing this demand construction across the board, then the Fed can then act by reducing rates again and being more accommodative, which seems to be when we're in a crisis, we turn to accommodation. And when it's hard to say times are good right now because of the inflation story, but when times are better, they look to try and increase rates and hope that the economy can still handle and cope with these very significant rate hikes. So all eyes on unemployment numbers, wage growth, and some of your economic data. I think the Fed have made it pretty clear that they are very much data dependent. So we will be looking for buying opportunities if market fundamentals, sentiment, and technicals are all looking quite positive, like they have been over the last few weeks in markets like this currently up on screen. We've been looking for buying opportunities. We were able to close out, some good profitable trades yesterday on the S&P 500. And so we will look for buying opportunities when they present themselves, but we'll be very aware of, overall market fundamentals and the data as it begins to hit the airwaves, how these markets are likely to respond, and for us to respond accordingly. So just to conclude, we'll be looking for, in this environment of kind of stagflation, higher inflation, lower demand, with increasing unemployment, we'll be very much data dependent, like the Fed. We'll be looking to capitalize again on these economic numbers. The economic sort of response to many indicators has been very bland over the last couple of years. That's now going to come back to the fore, so we'll be able to see if we can capitalize accordingly. But just to clarify, in this period of stagflation, we'll be looking for buying opportunities and risk-on sentiment when those opportunities present themselves. But our overall bias is still for now to the downside, unless something significant fundamental changes on the supply side of this inflation story. That could be the difference. So, for example, if we get a resolution in Ukraine, for example, in the war between Ukraine and Russia, that might have a positive impact and remove, a supply side constraint. If China starts to reopen fully and get back to normality, that might remove some of that supply side constraint. Then the demand side that the Fed are trying to deal with might have more of a solid impact on inflation, bring inflation down, and we might settle and have that soft landing that they're looking for. So it's pretty much steady as she goes right now. And like I said, we will be looking in the coming couple of quarters. We'll be very much data dependent and looking for buying opportunities when they present themselves, but also be looking for selling opportunities if those market fundamentals, risk sentiment, and technicals all start to turn bearish again. It's very important that we will adopt we'll apply a certain amount of flexibility in our thought, a bit of mental dexterity when we're applying our strategies to this market, because of this sort of stagflation type environment. Okay, so on that note, you may probably have questions based on what you've heard. It'd be interesting to see perhaps what your thoughts are. If you do have any questions at all about anything covered in this webinar, as always, you can email us at support@thelivetraderoom.com for more information, and we can certainly get back to you as soon as we possibly can. But on that note, thanks very much for joining us. From everyone here at the Live Trade Room, do stay tuned for our next video, and we look forward to seeing you next time. Bye for now.